Felix here. If you're worried about your favorite tech stocks, this is the right video for you. I'm going to walk you through the following stocks. Actually, I consulted, first of all, my chief researcher here, Hugh, who typed into Grok, what are the most popular stocks in the last 48 hours. And we got a nice list here. I'm going to run you through that. I'm going to copy this list out of Grok and I'm going to put it in and I'm going to create a little watch list right here, right now, inside TradeVision. And we're going to call it 2nd of August. I think that's the date it is today. I might be off by a day or two on that one. And hit enter. And now you've got yourself a watch list, which you can also view as a heat map and many other things. Now there's a cat on my screen, which might not be entirely helpful because he's chasing the mouse, but we shall plow on. The tool I'm using here, of course, is TradeVision, which is what I use for all my chart analysis and news and research and so on. It's something we built, so that's why I'm mentioning it. There's a free trial to down below if you want to play around with it. You also get access to dark pools and much, much more. But let's start with stock number one. Actually, before we do, let's look at how terrible is this sell-off really. The VIX, the fear index, is generally speaking the best place to look if you're worried about the market collapsing, tanking, or kittens eating your wires. And we saw a pretty big spike yesterday here, 21% in a day. That's pretty bigly. Now it's at 20. 20 isn't catastrophic, and you'll notice it also went up to 22, and then it came back down to 20 in a bit. I can only see half my screen because little monster is still on it. So if you look back at the last couple of months, where are we? We're sort of at like June levels. Not crazy. The tariff freak out of April, well, that was at 60. That's when you should be worried. So to me, this is a pullback. This isn't a crash. This is a little correction. This is not as bad as most people in my comment section are writing, like, oh my God, NVIDIA's down 2%. How can you do this to me? You're always wrong. I'm like, dude, we closed at actually Monday's level. So it's not exactly like, you know what I mean? You got to zoom out a little bit and get some perspective here on the size of this little mini correction. And if you zoom out, you will see that we have these kind of corrections all the freaking time on all sorts of stocks. So if you're used to things going up only into a straight line, you must be very new to this, and that's okay. Just learn that this is a normal process. There's nothing wrong with this. This is just a couple % pullback. And if you were to draw a trend line here connecting, say, the last 3 recent lows, well, we closed still on that uptrend line. Also, that yellow line on the chart here, which is what? Well, it's probably the most important line that you need to look at. It's the 50-day moving average line. Why is it important? Because every bugger on Wall Street looks at it, and therefore it becomes important. That's really all there is to it. 50-day moving average line, if you were above it, you're generally pretty happy. If you're below it, you're pretty concerned, right? We're still above it pretty significantly. So this isn't really that big a deal. Also, look at the sell-off volume. It was not that big compared to the day before or the day before that. So this isn't some massive catastrophic spike, some sort of mega crash. Remember January, 27th of January here? Look at the volume there. That was 817 million, crikey, 817 million NVIDIA shares traded that day. Yesterday, it was 200. So it's a quarter of the volume. So to me, NVIDIA, still in an uptrend. It all still looks good. A little bit of concern if it's going to go further. So yes, you're going to want to set a stop. What is a stop? Well, I actually call them profit locks, it's a way to lock in your profits. So say you bought here, which was our last entry point, and right now you're there. Well, you are up, right? But you're worried you're going to give it all back to the market, which is what most people do, but you're still up 26%. So where do you set your stop? Well, I can't tell you that exactly because that would be financial advice, but I'll give you some suggestions of where I might put it. How about below the recent low, right? Or maybe even at the 50-day moving average line, right? There would be both logical conclusions, and I always put them slightly below, not at the level. That's quite important because they get touched more often. How about Microsoft? Well, Microsoft bounced up and still 4% up on the Thursday. Yesterday, it gave up most of the gains, but I say most because there's some importance to that. So the gap up the day before, or from the gap up is still alive. The gap is still a real thing here. And that's actually important. So we didn't fill the gap either. We stopped way above it. So we're still a fraction of all-time highs. We're still above the 50-day moving average line. The volume wasn't crazy. This is all still looking pretty good. There is no reason to panic as of yet. How about Apple? Well, Apple is a shitty stock with no innovation that's been on a sort of suicide mission since, well, arguably January, right? They have not fixed any of their tariff problems. They're just hoping and praying and wishing that this is somehow going to go away. No real innovation there. Decent earnings, and their service business is a brilliant freaking business because they've got everybody locked into these devices, right? You got your iPhones and so on, and therefore you're going to consume Apple services. You're going to pay for software subscriptions, and they tax every app out there at 30% essentially. So it's a very, very good revenue stream for them. So I'm not saying Apple is going to go away or any of that. Obviously, they make good products, but they are at risk of being usurped, I feel. It's like Adobe, right? We're going to touch on Figma in a second, right? Adobe was the dominant player in that space, invented practically software as a service, subscriptions, and are fading into irrelevance because their stuff's insanely complicated to use and nobody really wants to learn it, except for people who've learned it who get really upset that people are using Canva instead of Photoshop or whatever, or CapCut instead of Adobe Premiere. So this is edited probably with CapCut, by the way, because it's way quicker. So even though my editor can undoubtedly use both, it's just faster. So what about Apple here? Well, yeah, I don't like it. This is a big, more concerning pullback. Why? The size of the candle compared to all the other candles. So don't look at the percentage. Apple doesn't move as much. So a 2.5% move in Apple is more significant than a 2.5% move in NVIDIA, which does it all the time. But what I really don't like is that volume here is accelerating as we're selling off. So as the sell-off happens, volume picks up, which means more and more people are selling. So falling down the stairs. And this is still, the recovery is basically over. And let's have a look at where the 150 sits. Yeah, so we didn't even make it to the 150-day moving average line, which is where your sort of long-term investor, generally speaking, wants to be above that line. So we're below that line. We've been below that line since basically January, with a few exceptions, and then dropped again below March. And if you'd sold even at this late stage here of March, well, you would have saved yourself a 13% pullback. So I'm not a fan of Apple at this point. Bezos' little plaything, Amazon. Now, the chart is not good, right? Because we have this massive gap down here. Tiny bit of recovery, by the way, in the aftermarket. Not a lot, but just a little, like popped up 2% or something like that. Volume is also increasing significantly down here as we're selling off. That's not good. Now, note, however, for you investors out there, and I'm not telling you what to do, I'm just telling you like the way I look at the markets, you're going to come to your own conclusions. That purple line there is the 150-day moving average line. And are we above it or below it? Put it in the chat, put it in the comments, above or below. Well, yes, you're right. Of course, we're above it. And that means it is still in a sort of investable sector. The next support level will be that 150-day moving average line that sits at 210, which also corresponds with the lows here. And what you'll note is that you do break those lines and then often bounce back up. So if you set your stops at the lines, you're going to regret it a lot of the time. You're going to want to be a little bit below that most of the time. And we can also look, because it's such a big stock, at where the institutions are positioned. So institutions, market makers, hedge funds, they provide us support here at $210. Why? They actually have to buy some Amazon at $210. It's the way their hedging strategies are set up. It's a bit complicated, but basically it's just options. And it means there's going to be some support at 210. Is it possible to break through the support? Yes. Because if enough people sell, then we can even overwhelm the market makers and the big guys in the market. But it still is a very useful indicator here that is actually completely unique, as far as I'm aware, to Trade Vision. So maybe check out a little 1-week trial to this and see if this gives you some value as it does to me. What about Meta? Well, Meta gapped up massively up. Whoops, let me draw a box. So Meta gapped up massively here, but it still held on to most of that gap. So the Meta pullback of 3% to me is neither here nor there. The volume isn't significant. We're above all the moving average lines. So to me, Meta continues to be very, very bullish. Just a little pullback, nothing to worry about particularly. What about Tesla? Now, if you're a Teslarati, if you're a diehard Tesla fan, you're not going to like what I'm going to say. And I'll tell you why. The first thing is, are we below the 50-day moving average line? No. Are we above the purplish 150-day moving average line? No. Right? Is the last high, that one, higher than the previous one? No. What about the previous one? No. So we're in a downtrend. We're in a really clear downtrend. And the only saving grace has been so far in this kind of consolidation sort of sideways thingy-majiggy, right? Because we were basically just going sideways, has been that the recent lows, well, they were higher, right? But we've, unfortunately, just dropped below the previous low. And that's not great. Bounced above it in post-market, so it's not the end of the world, but it's still concerning. The market makers probably helped. $300 was the support where they were going to buy. And you can check that out, by the way. You can look at like a 5-minute chart of the day, and then you can see, here's that 300-day line, and you'll see at the beginning of the day here where 10 p.m., 9:55 to 10 p.m., we were dropping in below that line. Well, what happens to volume? You see how the volume spikes? Why is that? Because the market makers step in and they buy, most likely. So they are actually the ones that prevented Tesla from dropping below 300 here on the day. So a little bit of support. Generally speaking, the more often you test that support level, the weaker it gets, just because they've already done their selling, they've done their hedging, they're going to unwind it. And then you can also see whether that support level is gonna drop in the coming days. So it's going to be something to watch out for. But to me, Tesla is in a slightly bearish consolidation pattern. I personally wouldn't buy it here. Obviously, completely up to you what you do with it. Palantir down 2.5% on a day where they got a $10 billion contract with the army. A bit odd, isn't it? But, well, it's run up a fair bit, right? So that's just why. So the things that have gone up the most are most susceptible, the most vulnerable to dropping. So what are you going to want to do? Well, you're going to want to have a stop in there. So you lock in all those big, beautiful, shiny gains. And I know a lot of you guys are up, 50%, 100%, 200%, 300% on Palantir or more. You don't want to give them away. So where would I set it? Well, there are various ways of doing this, and it depends a little bit on the position size. It depends a little bit on your overall portfolio exposure to the sector. Conservative would be recent low and be somewhere below it, somewhere like that. You could always pick the 50-day moving average line, again, be slightly below it. Or you could go a little bit lower here, or you could do a combination of all three. It just really depends on what you're looking at, or what your horizon is, or what your entry point is, and how much you're willing to give up, like, what is it for you? Is it 10, 20? Like, if you were up 300%, giving up 10 or 20% is kind of neither here nor there, and it might allow you to stay in this for longer. So it's probably a topic I could talk about for about 2 hours in itself, but I don't want to turn this into an entire profit lock stop conversation. Now, United Health is a very good example why when terrible things happen, we run for the freaking hills. The hopium is not an investment strategy that most people have. So when this gap happened up here, because they were accused of all sorts of possibly illegal shenanigans, it did two things that are fatal. It crossed the 150-day moving average line, it crossed the 50-day moving average line, and it gapped down, and it did so on fairly big volume. And what that means is what? We get the heck out. Actually, I would have gotten out before that, to be honest with you. And again, this is not hindsight talking, these are just rules. It was actually in December that we wanted to get out, because that is when the moving average line started to slope down. So actually, we wanted to get out here. And had you gotten out there because you had automated risk management, well, you've saved yourself from 60% down right now. Not helpful if you're still in this. It's a lesson. It's tuition you've just paid to the market to learn that having no automated risk management leads to a bloody nose. And this is the bloody nose I've ever seen one. I don't like it. Volume is increasing. We're falling off. We're below every moving average there is. It's a falling knife. I'd run for the hills, but that's just what I would do. You've got to decide what you want to do here. Reddit, I was going to say the scum of the earth, but that would be an unfair description for their business model. This is a cesspit, isn't it, Reddit? I don't like Reddit. Most of the unhappy people in the world seem to find themselves on Reddit. I'm sure there's some useful content on there, but anyway, it's a great business. It's sort of a social platform without the bells and whistles, and very, very good search ranking. And, well, they've done something big and beautiful. So we've had two breakouts here. The first was down here, which was there. That was your first breakout. And that corresponds with massive, massive institutional buying, as you can see in the volume. And we then consolidated up, bounced along the 150-day moving average line for a little bit, and then boom, did the same thing again on earnings. And if you missed the first one up, then probably missed the second one up. So do we buy at the top here when something like this happens? Do we chase this? Well, for me, it's always kind of a question of how extended are we? It's a 25% move up in 2 days. The likelihood of a pullback is significant. So I would rather wait for the pullback. If there is one, it could be interesting. And if there isn't one, guess what? There are about another 7,000 stocks you could buy. So we don't need to be in Reddit. So don't have FOMO. I used to have a lot of FOMO. Just forget about it. It's irrelevant. There are so many opportunities we can find every single day. We didn't need to be in this one, but this looks glorious. Big, beautiful bull market breakout on a day where the market was having troubles, which means it's a strong breakout. SoFi is keeping people up at night. Look at how many gaps we have here. So get earnings. They're initially glorious. So you get a gap up. You then get an explanation that, well, people start to understand this 7% dilution they've done. So we recover a bit. We then gap up after that, which is rather bullish. But you will note that that red candle up there looks like this. It's an upside down hammer. It's not a very, very bullish candle. It's quite the opposite. It looks bullish, but it's actually bearish. And then we had another gap down here yesterday, and we closed not great. But market's calming down. And if you just zoom out a little bit, what have we actually achieved here? Just absolutely nothing at all. And that's okay. So the stock is still in a consolidation pattern. I assume it's waiting for interest rates to come down, which is going to make them a lot more money. Why? Well, one reason is it's a bank. And secondly, they offer student loans, right? Now, when do you refinance your student loans? When you can get a cheaper loan. So if rates come down, you can refinance it at a lower price. Makes a lot more sense. Opendoor, which is just a crazy meme stock thing that is probably bankrupt. Quite impressive that after this crazy rally up, it has actually consolidated somewhat. So it would say to me that the hedgies are still in this and are still playing with it, and they're hoping for another squeeze up, which is what this is. Personally, I'd stay the heck away from this stuff. There are faster and more enjoyable ways to burn your money than being in something like this, which is just very, very volatile. And for most people, 42% moves in one day is not really something you want to see in your portfolio. So I would just stay the heck away from this. This is one I've never heard of, Anavex Life Sciences, but apparently it's the latest thing on Wall Street bets. And why? Well, it's just moving a lot. So from bottom to top here, and there's 100% move in a month. And they like that sort of thing over there. You got to ask yourself whether you like that sort of thing over there. One way, by the way, there is ways to make money out of this. Like I have some friends who run hedge funds and so on, and they love these Wall Street bet setups because it's so easy to take money off people. Nice friends, I know. Well, they've got a family to feed too. No, it's just, if you're going to go into a casino, you're going to lose. If you're trading this sort of thing and you haven't got a structure that you could break down in like 3 simple steps and explain to somebody that you get exactly the same result, and if you're honest with yourself, for most people that isn't the case, then you're going to lose money. So the entry point was here, and that was a good entry point. Right? And that's based on the rules that I keep yabbering on about on this channel. And you went up 45%, and then now you stood up 14%. So you can see how people make money out of this. It's just, again, for 99% of people, I'm not trying to belittle people. I'm just saying it's just not what you want to be doing with your time. It's just too complicated. It's just too volatile. You want to set up more the sort of buy it and forget it type stuff with stops in place, and then spend 2 or 3 hours on a Sunday managing your portfolio, and that's it. And you don't have to do anything in the week. With this, you're going to have to be a little bit more active. Now, Figma is this. So Figma is a company that Adobe tried to acquire a couple of years back for about 20 billion. I think it listed for around about 100. And it didn't just list, it actually went up pretty bigly on the first day. I thought from where it started, it was like 250% or something like that. I guess there was a gap up at the beginning here. That was probably what happened. So pulled back yesterday a bit. I'm not a fan of IPOs. And first of all, you could only get one share, so who cares? Why bother? And second of all, 60% of the funds raised in the IPO went to existing shareholders who were selling. To me, that's a red flag. Why the heck are these guys getting out? They think the real money has already been made, right? And these are institutional investors. And then last but certainly not least, the S&P, 1.6% down. First 1% move we've seen in many, many, many days. And it was a gap down rather, which isn't pretty. But you also got to zoom out and just connect the lows and see, well, what's the trend here? Right? That blue line there, let me make it red. That's the trend. And we're still above that trend. So yeah, we're bouncing. We're bouncing down like we did here and like we did there, and we're doing it right now. But I don't see the end of the world here. I just see the market getting a little jittery about tariffs and not really fully understanding the jobs numbers. US government jobs numbers are just plainly made up, but it's fiction. It's just complete nonsense. So Biden was pretending that there were millions higher than they ever were. And what's Trump now doing? Trump is now making them lower than they possibly are. And why is he doing that? Because he wants interest rate cuts. And it's one way to force the Fed's hand is just to say, well, you have a dual mandate. It is what? It is jobs and it is inflation. Now, harder for the government to do much about inflation, but it can certainly tank the jobs data by just making up the jobs data. And then he fired the lady who makes up the jobs data. BLS has always been BS. And it's been that under every president. It's a government decision of what data they put out. So I wouldn't give it too much attention. I looked a little bit harder into that data. Of course, the government jobs that were lost. There are also a lot of non-US born jobs were lost. So a lot of people who are not native Americans, I don't mean native, born in the US, you know what I'm saying, have lost their jobs. And that's probably got something to do with the much, much heavier ICE enforcement on that. So that's what's going on over there. So to me, it doesn't look like an economy cratering, and with the tax cuts going through and all the government massive spending that's going on, I find it hard to see how the economy is going to crash. And secondly, this is going to get us rate cuts, right? The market's going to like the rate cuts. Maybe not the moment we get the rate cuts, because the market's going to worry about jobs. But fast forward a little bit, the market's going to like the rate cuts. But you know what? Either way, we can make money out of this scenario. Why? Because there's always something that's going up. Like I did a little video yesterday on this is a niche stock. Again, this is not necessarily for most people. US rare earth thing. It went up not just 10% yesterday, but then it went up another 2 or 3% after hours. So it went up like 13% yesterday. How do we spot that? Patterns, right? Patterns and a little bit of information. And there are these plays which allow us to make money even on days where the market isn't looking that good. So all I'd say to you is don't scream manipulation, don't scream it's all over, don't run for the hills, don't get panicked. Just make sure you've got good risk management, make sure it's automated so the emotions don't ruin it for you, because that's what happens. And just learn a little bit about the market, because I think it's the fastest and easiest way to financial freedom. And that's why I run this channel and community here, because that's what it did for me. It helped me to retire. And it can do the same for anybody, I believe, who just puts in a little bit of effort to learn how this works rather than just throwing darts at a board. So if you got some value out of this, share it with a friend, and check out Trade Vision if you want to get news and everything else. And I wish you a glorious and successful next week. This one stock is about to blow up, in my humble opinion. Just like MP Materials, which I covered on 28th of April, check the video. This one stock might skyrocket in just a few days.